Welcome to GRE. I'm your host, Keith Weinhold. President Biden tries to help the housing market. Everyone wants to know when interest rates will be cut. I'm asking, why would we cut rates anytime soon? Yes, some Fed talk today and a lot more on Get Rich Education. When you want the best real estate and finance info, the modern internet experience limits your free articles access, and it's replete with paywalls, and you've got pop-ups and push notifications and cookies disclaimers. Ugh. At no other time in history has it been more vital to place nice, clean, free content into your hands that actually adds no hype value to your life. See, this is the golden age of quality newsletters, and I write every word of ours myself. It's got a dash of humor, and it's to the point. To get the letter, it couldn't be more simple. Text GRE to 66866, and when you start the free newsletter, you'll also get my 1-hour fast real estate course completely free. It's called the Don't Quit Your Daydream letter, and it wires your mind for wealth. Make sure you read it. Text GRE to 66866. Text GRE to 66866.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE. From Bowmanville, Pennsylvania to Louisville, Kentucky, and across 188 nations worldwide, I'm Keith Wayne Holden, and I'm grateful to have you here with me for another week. This is Get Rich Education. I'm about to discuss the case for not lowering interest rates, and you'll hear a clip of Jerome Powell commenting on the real estate market shortly. But first, President Biden recently made a State of the Union address, and he unveiled his plan to help the undersupplied housing market. Part of the plan was to help the buyer side, the demand side, with incentives, which I'm not sure that we need the support over there on that side. And now that would juice real estate prices more. On housing supply side, Biden's plan creates a $20 billion fund to build more rental housing and kill some construction restrictions. Okay, yeah, that's the key part of the plan. And that's more helpful. Help that supply side. Perhaps the most interesting part of the plan is a $10,000 credit that's meant to incentivize people to sell their starter homes. That's our president on housing. Let's pivot over to Club Fed. Yeah, welcome in to Club Fed. There's no cover charge. For some reason, Janet Yellen's still hanging around chaperoning, and she still looks like my grandma. Earlier this month, Fed Chair Jerome Powell acknowledged that the commercial real estate loan problems could cause manageable problems for regional banks, possibly for years. I find it interesting that he uses the word manageable when acknowledging problems on the commercial side. I mean, we'll see. But that kind of reminds me of one of Powell's predecessors, former Fed Chair Ben Bernanke, in 2007, saying that the subprime loan problem was contained, is the word that he used. And we all know that, the mortgage meltdown contagion of 2008 was anything but contained. Today, when we talk about Powell and interest rates, back around 2021, he got beaten up pretty badly for not acknowledging rising inflation sooner, but he's brought inflation down to about 3% without a recession, so some credit is due there, but not too much credit because the game's not quite over, and it took that torrid set of interest rate increases where they climbed a cliff in order to quell inflation, and that already hurt a lot of people, including those erstwhile commercial real estate people and their loans that jumped up to a higher interest rate. Now, we talk about interest rate policy. Let me give you something that's easy to remember. High rates mean a strong economy. Low rates mean a weak economy. With that in mind, let's look at where we've come from, and then we'll look at the future. A lot of people got drunk with easy money starting 15 years ago because it was nearly free to borrow. An interest rate of 0 at the federal funds level, that gives you no incentive to save and more incentive to borrow and spend. Well, the federal funds rate was zero from 2009 to 2015 to get us out of the Great Recession, and then it was zero again from 2020 to 2022 to help lift us out of COVID. That's the past. Since the federal funds rate, which a lot of other interest rates are based off of too, since it quickly shot up starting 2 years ago, it's now been a full 8 months since rates have moved at all. They haven't budged since July of last year. So that's where we are now, and I'm fine with them staying here for a while. Now, Jerome Powell recently testified to the House Financial Services Committee. Let's listen in to him discuss real estate as he's questioned.
The housing market is in a very challenging situation right now. You have this longer run housing shortage, but at the same time, you've got a bunch of things that have to do with the pandemic and the inflation and our response with higher rates. So you have a shortage of homes available for sale because many people are living in homes with a very low rate mortgage that they can't afford to refinance, so they're not moving, which means the supply of regular existing homes that are for sale is historically low and very low transaction rate. That actually pushes up prices of other existing homes and also of new homes because there's just not enough supply. The builders are busy, but they're running into all kinds of supply issues still around zoning and workers and things like that. So it's quite challenging. And of course, rates are high. So people who are buying, a lot of the buyers are cash buyers or are able to actually pay without a mortgage because mortgages are expensive. I will say the first problem, the longer run problem of supply, is a longer run problem. The other problems associated with low rate mortgages and high rates and all that, those will abate as the economy normalizes and as rates normalize. But we'll still be left with a housing market nationally where there's a housing shortage.
That's Jerome Powell on real estate, and I'm surprised that he said rates are high. Do you know what the long-run federal funds rate is? It is 4.6%. That's the average, and currently it is at 5.3%, where it's been for a while. So it's not that much higher than average. The 30-year mortgage long-run average is 7.7% per Freddie Mac, and that's been hovering around 7% for months now. So therefore, both key rates are close to normal today. But despite that fact, seemingly everyone is waiting for the Fed pivot. And what the Fed pivot means is when they reverse their monetary policy stance, meaning when they start lowering rates again after the long increase cycle that we're coming off of. Well, I'm here asking, why should the Fed pivot and lower rates since they're near normal now? All right, let me give you some real perspective here. Look, I'm going to describe a scenario to you and tell me what you think about this. Imagine a dreamy bygone era where there happened to be this period that saw a strong national labor market, plenty of jobs, steady GDP growth, rising wages, and inflation a little above normal. All right, now that you're done imagining that cloudy slice of economic Americana, pretty rosy scenario, well, then you might consider raising rates in a situation like that to help cool off wage or price inflation. Well, you know what I just did? I actually just described to you where we are today. That's what today's conditions are. Yet there's still talk of lowering rates later this year, and now you might see why I'm questioning that, because the economy doesn't need the help. Sure enough, in front of that same committee, Fed Chair Jerome Powell and other Fed officials, they did say that they expect interest rates to come down later this year. I hope they're not doing that for political pressure or to try to reassure the stock market. Those would not be good reasons. And dropping rates to zero at the first sign of a crisis, that shouldn't become a habit. Because look, before the 2008 crisis, when they dropped them to zero, going all the way back to at least the 1950s, maybe longer, rates were never zero that entire time. See, if the Fed just steps back and doesn't touch rates for a while, then it's all the longer that more free market forces can prevail. I don't know that we need to constantly tinker with rates like a greasy guy crawling under his classic car in his garage and tinkering around with it. Another reason that the Fed shouldn't lower rates yet is because it needs to hold on to some rate cut ammunition in case there's a recession, because in a recession, one of the best tools that the Fed has to cool it off is by lowering rates in order to incentivize investment in a slow economy. But see, what happens if you use up all your ammo? You already start lowering it and you're already near zero, and then we have a recession. I don't know that America is ready for negative interest rate policy like some other nations have tried. And by the way, if you earn a negative interest rate, that means that if you park your money at the bank, you have to pay them interest rather than the bank paying you interest. They get the use of your money and you have to pay them for parking it there. That's a negative interest rate. Well, recessions have a strong correlation with lowering rates. I mean, just look back historically. Again, history over hunches. But, if you don't follow this stuff, the short story of what's happened the past several months is that interest rate cuts keep being delayed because of stubborn inflation that just won't fall down to the Fed's desired 2%. And Powell also recently said that he needed just a bit more evidence that inflation was coming back down to normal levels before he'll reduce rates, although we're not far from it. That's exactly what he said. Now, if rates go back down, and it's probably when rates go back down, look for the housing market to break loose. The interest rate lock-in effect will wither away, property affordability will improve, and there's a good chance then for a strong upward jolt on property prices, on those values. Last year, there were some studies done, and it was interesting. It showed that 5.5%, that is the magic mortgage rate level that makes the real estate market want to really transact. But this year, with rates that have stayed higher longer, surveys say that level is now up into the high fives. And there is another factor. As interest rates drop, the cost of maintaining our national debt also decreases. That is part of the calculus too. Well, if you're a Fed watcher, a Fed speak geek, you are in luck because though it's not really much of a spectator sport, and the parties at Club Fed and all their PhD economists really aren't all that lively, if you're so inclined, one of the Fed's 8 annual meetings where they announce any interest rate changes happens in just 2 days, and then the next 2 meetings conclude May 1st and June 12th. If you like to track rates, especially if you're perhaps in the mortgage loan process right now, my favorite website is Freddie Mac. The mobile app that I use is the Mortgage News Daily app. Coming up here on a future episode of the show, retirement. Some want it, some don't. Real estate might give you an early retirement option, but I'm asking the question, do you want to retire? Do you ever want to retire? We're going to go deep on that. And then, what even is your definition of retirement today? You could learn something about yourself on that upcoming episode about retirement here. Speaking of spectator sports, no, this isn't really one either, but you could have gotten on a jet and paid for a ticket to watch me speak, or you can listen free next to part of the recording of that presentation of mine at the Spartan Summit from earlier. They had me kick off their event. I was their opening speaker, and I shared some things with that audience that really shake people up, that they've never heard before. You will hear both new material as we play this and some things that you've heard before here on the show. But even those things I say differently in a format like this. So straight ahead, it'll be wealth mindset first, and then the real estate investing fundamentals. If I could condense the best GRE content and principles into less than an hour, that's pretty close to what this presentation is. You'll hear about the first half of it coming up straight ahead. You're listening to Get Rich Education. I'll just tell you, for the most passive part of my real estate investing, personally, I put my own dollars with Freedom Family Investments because their funds pay me a stream of regular cash flow, and returns are better than a bank savings account, up to 12%. Their minimums are as low as $25K. You don't even need to be accredited for some of them. It's all backed by real estate, and I kind of love how the tax benefit of doing this can offset capital gains and your W-2 job's income. And they've always given me exactly their stated return, paid on time, so it's steady income, no surprises, while I'm sleeping or just doing the things I love. For a little insider tip, I've invested in their Power Fund. To get going on that, text family to 66866. Oh, and this isn't a solicitation. If you want to invest where I do, just go ahead and text family to 66866. For a lender that's a specific expert with income property, you need Ridge Lending Group, NMLS 42056. In GRE history, from beginners to veterans, they provided our listeners with more mortgages than anyone. It's where I get my own loans for single-family rentals up to fourplexes. Start your pre-qualification and chat with President Chaley Ridge personally. They'll even customize a plan tailored to you for growing your portfolio. Start at ridgelendinggroup.com, ridgelendinggroup.com.
This is Hal Elrod, author of The Miracle Morning, and listen to Get Rich Education with Keith Weinhold and Don't Quit Your Daydream.
It is with great pleasure that I get to introduce you to our first speaker for today. He is the founder of Get Rich Education and host of the popular Get Rich Education podcast. His show has nearly 3 million listener downloads from all across the world. He also actively invests in apartment buildings, single-family homes, and agricultural real estate. He is a member of the Forbes Real Estate Council, and his work regularly appears in Forbes, Business Insider, and Rich Dad Advisors. Today, he's taking us back to the basics to discuss why real estate is such an attractive and solid investment option for those looking to find their own financial freedom. If you've listened to the Get Rich Education podcast, then you've heard him speak. But today, we are so thrilled that he's kicking off our second annual Spartan Summit. Ladies and gentlemen, here's Keith Weinhold.
Hi, my name is Keith Weinhold. I am the founder of Get Rich Education. My presentation is called Simply Why Real Estate, because if you don't know why you're doing something, then you really won't care about how. And I'm really pleased to be first up here at the Spartan Summit. You're going to hear some things that you've never heard before today. For example, compound interest does not build wealth. Getting your money to work for you does not build wealth in the real world. And real estate investors, one of the first things they need to do is actually stop looking at property. So what is this financial heresy that I'm talking about? Well, I think it's going to be pretty clear to you in less than an hour's time here. It all starts with you thinking differently. You really need to open yourselves up, and I think you start to have the realization that any outsized thinker or doer over time did think outside the box to have that outsized impact, whether that's Thomas Edison or Jeff Bezos or Sarah Blakely or Warren Buffett. They all dared to think differently. And if you're not getting the results that you want in life, maybe a great question to ask yourself is, am I thinking differently enough? When you come of age in the world, whether you finish high school or college or whatever it is, you probably never really have this vision for yourself where you're intentional and you say, yeah, I can't wait to go out there and live a small life. But then you know what? That's exactly what everyone does. Everyone goes out and lives a small life. So with thinking differently, Mark Twain's got some great quotes about thinking differently. Mark Twain said, as soon as you find yourself on the side of the majority, it is time to pause and reflect. I absolutely love that from Mark Twain. Mark Twain also said, one of his lesser-known quotes is, go out on a limb, that's where the fruit is. Yeah, I absolutely love that one. So being a conformer does not build wealth or does not have a substantial positive impact on other people. And I wouldn't suggest that you think differently or do something differently if I weren't doing that myself. I don't know that I've had the outsized impact of some of those visionaries and inventors that I mentioned earlier. I probably haven't had as many years on this earth yet as them either. But one thing I did that was different is years ago, I moved from Pennsylvania, where I was born, raised, and lived much of my life, to Anchorage, Alaska. Well, that was deemed by Pennsylvanians and a good part of my peer group as a strange and unusual thing to do, but I knew that a place like Anchorage fit my interests for skiing and mountaineering because I had vacationed there. That was the place for me. The first ever home that I bought of any kind, I was only a rent-paying tenant up until the day I bought a fourplex building where I lived in one unit and rented out the other 3. That was pretty strange. I didn't start with a single-family home. I quit my job, my good-paying day job with benefits for residual income from real estate. Another strange thing to do. I launched the Get Rich Education podcast in the year 2014. Kind of weird, talking to myself in a little room all by myself. A lot of people didn't understand what I was doing then. So those are just some examples of some different things I've done. You know, your different things are probably going to be different, but you really don't want to be a conformer. If you think about it, high school was the place where you were rewarded for fitting in. But when you become an adult, really you get rewarded when you stand out and you don't be that conformer. When we talk about my presentation called Why Real Estate, we're really taking it from philosophy all the way through to the numbers here. And years ago, I would have loved to know why real estate made ordinary people wealthy. You know, an interesting thing, I'll just tell you, when I bought that first fourplex building, I didn't even know what terms like cash flow and equity meant. I did not even know the meaning of those terms, and here I had owned a substantial building, a $295,000 fourplex, which is a lot for me when I was working a day job, and I bought it. And I think as a layperson, before I bought that building and got down this road, I kind of thought, now how could real estate possibly make people wealthy? Because real estate only appreciates at about the rate of inflation over time. That's about all it does. And I found that that part's true. And then real estate, it has the elements working on it from the outside, and it has tenants like working on it and wearing it down and degrading it from the inside. So how could real estate possibly be a good investment? I didn't understand that. I tell you, it's really important for you to learn from someone that's actually doing it, that's inside and doing this thing. I'm about as active as a real estate investor could possibly be. I own single-family rental homes up to larger apartment buildings, even some agricultural real estate. So it's important to learn from someone that's doing it, and this presentation is really what my ears have shown me. And when we talk about how you have to think differently and be opened up, you know, interestingly, we're in what people call the information age. We have been for decades, this information age. But I like to say we're really in the affirmation age, because most people would rather be affirmed and comforted in what they already believe rather than get informed with information, because it kind of shakes you up a little bit, just like you're going to be shaken up today. So I would say don't only seek affirmation, which is what most people do, seek information as well, and then make up your own opinion. What is wealth? You know, we kind of begin with the end in mind. Let's ask ourselves what is. I think that there are a lot of different definitions for that. I mean, money's got to be one of the first things that come to mind. And we are talking about financial betterment here. But, you know, it seems like people that want material things more than experiences, it seems like a lot of those people that want material things get knocked and get criticized. I don't know, like I would rather have experiences than stuff, but really the abundance mentality is why not have both experiences and stuff if they're both easily within reach, because they really are. But I think really the best definition of wealth, it's one that I've never heard criticized once in my life, is freedom. Having the ability for you to do whatever you want to do whenever you want to do it. Real wealth is having that time freedom and not having to have a job, being job optional. You can continue to go if you want to. Wealth really is freedom. So let's talk about money and freedom and what freedom really isn't. I've actually got a really nice proposal for you. Just imagine this. Imagine you're 20 years old. I'm talking to the 20-year-old version of you. I'm going to tell you that I want you to mow my lawn for me regularly, and I am going to pay you $114 an hour to mow my lawn. Pretty amazing, right? Like, doesn't that sound incredible? Yeah, that sounds like a good deal. You'd probably be pretty excited about that. Maybe even now you'd be excited about that, not just the 20-year-old version of yourself. Sounds amazing. But could you ever really get wealthy off that? Probably not. Probably not. Because in fact, you would have to work every single hour in a year, all 8,760 hours in a year, just to make your first $1 million. And that ain't happening. This scenario is completely implausible. No one would really pay that much to mow a lawn, most likely. And you couldn't work every hour in a year. You couldn't eat, you couldn't sleep, nothing like that. So it's really numbers like this that I think kind of slap someone in the face if they think they can just hustle and grind their way to wealth. I really don't think that's the best way. In fact, what I would share with you is that this is the exact opposite of being wealthy. This is the opposite of growing rich in your sleep, because you have to continue to trade your time for dollars in order to make this work. You need to continue to sell your time for money in order to make this work. And then really what happens when you come of age and get older and you're probably not mowing lawns for money anymore, you end up in a place that looks kind of like this, okay? And this is the workplace. What happens in the workplace? I like to say the workplace is where you pretend to work and your employer pretends to pay you. But there's probably a pretty good chance, and I would probably call this a pre-COVID workplace, but you probably did spend most of your working years so far in a pre-COVID workplace. Those people are packed in pretty tight right there that I think, but don't worry about being in the workplace. You've got the commute to relax anyway, right? It shouldn't be so bad. You're grinding, trading your time for dollars. But also, this worker here, they're doing something else that the lawnmower didn't do. Okay, we're going to say that you mowing the lawn, that classified a poor person. You had to work for money. But the middle class person here, they're also working for money, but they do have a better and higher use of their investing dollar. They're also getting some of their money to work for them in something like a 401k or a 403b or a thrift savings plan or an IRA or a 457 plan or something like that. So the middle class person here, they get some of their dollars working for them. That's significant. But look, here's the real point. Getting your money to work for you doesn't build wealth, and all these middle class people here, they think there couldn't possibly be anything better than me getting my money out there working for me, so I'll just leave it there. It can't get any better than having my money work for me. Well, that's not true, and I find it to be a real conundrum and paradox that people will spend tons of time learning about how work works. They spend zero time learning about how money works, but yet money is the only reason that they even go to work, which is really unusual to me. See, getting your money to work for you does not build wealth. Now, that doesn't sound too bad on the surface, but if you think about a 10% return over the long term from the S&P 500, which is about what you could expect, most people don't even consider the 5 deleterious drags on that 10% of inflation and emotion and taxes and fees and volatility, all 5 of those simultaneous drags. Now, I think some of these are easier to explain and understand than others. For example, if you have a 10% rate of return and 3% inflation, which is a long-term historic norm, you're already down to a 7% inflation-adjusted rate of return. We haven't even subtracted out those other 4 things yet. And I like to look at things in really long timelines. So let's take a look at some long timelines with some returns you can expect. And therefore, I also like to look at inflation in a long timeline. We'll call it 3% inflation. You've got to beat inflation substantially in order to have any real return. And things like stocks, mutual funds, ETFs just don't do it. So let's look at long timelines of, let's say, over 100 years here. I talked to you about the drag of inflation. Let's talk about the drag of volatility. This is little understood. Stocks are quite volatile. They go up and down. They're choppy, where real estate is a substantially smoother ride. So let's look at 2 different lines here on this graph. Okay, over the last 120 years, since about the year 1900, the stock market has averaged roughly that 10% return, 6% from capital appreciation and 4% from dividends. So therefore, the green line, this shows capital appreciation. You're probably pretty used to seeing this, the compound return. This looks thrilling. Your mutual fund advisor loves to show you this line. This line goes like exponential. Like, who wouldn't want some of that, right? Some even believe Einstein was purported to say that compound interest is the 8th wonder of the world. So what's wrong with it? Where does it break down? Okay, well, I'm going to show you a second line, and both of these lines show a 6% return from the year 1900, more than 120 years of return. So the green line is what you think you got, but what did you really get with this 6% quote-unquote compounded return? You don't get this. You get this. That's what you really got. This is the deleterious effect of volatility on stock returns. You're like, well, whoa, wait. Well, why did that happen? How did that happen? The difference here is that whole effect of, let's say you have a $100 stock and it loses 50%. Now it's down to $50, but it gains back 50% the next year. Now it's only up to $75. So you've gone from $100 down to $75, even though you lost 50% in year one, say, and you gained 50% in year two. So it's really a mathematical problem. Another way to say it is that time spent making up previous losses is not the same as growing your money. It's not the same as compounding your money. In fact, the tip of the blue line, the end of it there, today's dollars, that's only 38% of what you get at the tip of the green line and what you expect to get. So a lot of investing has to do with expectations. If you expect the green line and you only get the blue line, that's when you end up like this, sort of these stereotypical stock kind of photos when people can't pay the bills. And the interesting thing is we've been in a 401k based world for 35 to 40 years now where that's sort of the norm. People continue to end up like this, but yet they still get into 401ks and think getting their money to work for them is a way to build wealth. Well, we're here and we're talking about why it isn't, and that is the problem. And compound interest does not bail people out of their income and savings problem either. 4 out of 5 people have less than 1 year's worth of income saved for retirement. This is why we have a retirement crisis today. You can't count on compound interest alone. So I would like you to imagine another pretty dreamy scenario for yourself. Okay, and this is a pretty important exercise. This is some better news for you. I want you to think about how much money you think you're going to make, both earned and through investment returns, your entire life. We'll say it's inside this vault right here, okay? And the reason that this is some better news is, you know what? If you're in this room, the chances are that you're going to have a greater net worth and greater residual income than other people will because you've shown up here. You've shown that you're interested in this. And a lot of people, they don't think about inflation and they underestimate their life's earnings. So let's say that your entire life's net worth, accumulated assets would be the way to say it. Let's say your total accumulated assets are coming up to $8.5 million. How's that sound? $8.5 million. That sounds pretty good, doesn't it? Wouldn't that be amazing? Now, just imagine this. I'm going to give you all $8.5 million at one time. You're going to receive this all at once. How would that feel? Wouldn't that be amazing? How fast are you going to quit your job? Hopefully you at least give the 2 weeks notice. Where are you going to go on vacation? Are you going to have time to care for your loved ones now? Or be a volunteer at Habitat for Humanity, or finally have time to be a deacon at your church, or do whatever's important to you because you are job optional now with this $8.5 million delivered all at once. But wait, here's the thing. I didn't tell you when the $8.5 million is being delivered to you all at once. It's all going to be delivered to you on the last day of your life. That's when you're going to get it. What do you do now? I guess you're not going to do your around the world trip anymore, right? You're just saying your goodbyes to people. It's the last day of your life. All right, what if you got 80% of this amount then at age 80? Would that be a little better? Or 70% at age 70? Would that be a little better? So my point is timing matters. I don't know, what can you really do if you get 70% of it at age 70? Maybe when you're 73, that's the last year you can really paddleboard very well because you've had 6 knee surgeries by then or something. So timing really matters. So you really want to be invested in something that gives you an income stream, that provides liquidity to you over time. You really, ideally, most want this sort of lifestyle smoothing effect where they get this income metered out to them. So liquidity really, really matters. And what helps achieve this smoothing? It is those income streams. In fact, I would go as far as to say that the standard advice that you hear out there from people, invest for your future, period, I'd actually say that's bad advice or incomplete advice. Why would you only invest for your future when you can invest now for a stream of income now and not hemorrhage or sacrifice the future at all, which is really something that you can do with real estate. Build an income stream now. It typically appreciates faster than stocks, and you didn't sacrifice the future at all. There's more bad advice out there. I think sometimes you'll hear a person say, for example, oh, pay yourself first. That means put your money in a traditional retirement plan or something like that. Pay yourself first? Wait a second. How in the world is it paying myself first if money is deducted from my paycheck when I'm, say, age 35 and I don't get that back until, say, I'm age 75? Look, with the 401k, the most popular plan in the United States, you cannot take penalty-free distributions until between age 59 and a half and 70 and a half. That's just when they begin. And you also must begin paying taxes on it at that time. So would you really find it a good trade if you trade away 1 hour of your 35-year-old self and in return you get 1 hour of your 75-year-old self? Does that sound like a good trade? A lot of people that invest in these traditional retirement plans, that's really the trade that you're making. And I used to be involved in traditional retirement plans. I used to think they were the best thing until I looked at it. A lot of people talk about the benefits of delayed gratification, and I think delayed gratification, there's something implied in that being a desirable thing, that there's a positive outcome and that there's some big reward for delayed gratification, but it's definitely not guaranteed. We're not guaranteed tomorrow. So I think 401k plans, they're known as tax deferral plans, but I think you could just as easily call them life deferral plans because that's principally what they do, in my opinion. So let's go back to the lawnmower. The lawnmower, again, I'm classifying that as the poor. However, the middle class are doing a little something different. Remember, not only were they working for money, they got some of their money to work for them, oftentimes in a retirement plan. I guess they're symbolized by these, what do they look like here? Construction engineers or something like that. They're middle class. The wealthy are doing something that the poor and the middle class aren't doing. The middle class, they get their money to work for them. What do the wealthy do? What is this guy doing right here? What does he have figured out? He knows the best and highest use of his investing dollar is not getting his money to work for him. It's getting other people's money to work for him. And in real estate, you can actually get other people's money to work for you 3 ways at the same time, and you can do it ethically. I think it's important to be ethical. You never get called a slumlord. Like, for example, my mission is to provide housing that's clean, safe, affordable, and functional. You can use other people's money 3 ways at the same time. We'll call this OPM, other people's money. You might have seen that abbreviation before. You can do it 3 ways simultaneously with real estate. And, the great thing is you don't need any degree. You don't need any certification at all in order to ethically use other people's money 3 ways at the same time. The first way is with the bank's money. Like, for example, the way I bought that first fourplex is with 3.5% of my own money as a down payment, and I borrowed the other 96.5%. So you use the bank's money for the loan and leverage. You use the tenant's money for that all-important income stream and for paying down your loan for you. And then the third way you use other people's money simultaneously in real estate is that you use the government's money for very generous tax incentives, like you can defer your capital gains tax endlessly. You can get a mortgage interest deduction. There's something called depreciation, which shelters a portion of your rent income from ever getting taxed. Don't get your money to work for you, or at least don't make that the focus. The focus should be on ethically getting other people's money to work for you. And, I think really a concept like this harkens back to the late business philosopher Jim Rohn, right? Jim Rohn said, formal education will make you a living, but self-education will make you a fortune. So you're really getting a condensed self-education right here. So let's just look at one of these three. Let's talk about that tenant income stream. That's the important one. That's the one where you build residual income if you do want that freedom, if you do want to build enough of that residual income so that you can be job optional and do what you want to do. Think about it conceptually. Think about how amazing it is that the tenant pays you what they pay you. The tenant pays completely 1/3 of their income most of the time in rent to you, 1/3 of the time. So that is like you getting paid and that tenant going to work for you 10 days every month. We'll call it the first 10 days of every month, just to work for you and to pay you. Do you have any idea how amazing that is? Think about that. What other company gets 1/3 of people's incomes and can do it at scale? Apple doesn't get 1/3 of people's incomes. Think of all the stuff that people buy on Amazon, all those consumer products, but people still don't spend 1/3 of their income on Amazon. So this is amazing. Like, who else gets this? Really, nobody but you in real estate. So, we're getting you to think differently here. This is just, again, one of the three ways that you can ethically employ other people's money. The others were the bank's money and the government's money. We're talking about the tenant's money here. All right, that was almost the first half of my presentation at the Spartan Summit. We are Get Rich Education. So to review what you learned earlier in the show here today, keeping it real simple, high rates are for a strong economy and low rates are for a weak economy. A Fed pivot means when they reverse their monetary policy stance, for example, going from raising rates to lowering rates. From that point where we left off on my presentation there, I go on to discuss more about the importance of cash flow, how leverage beats compound interest, inflation, property selection, properties to avoid, and more. If you'd like to watch all of that presentation, you can in its entirety with the video on the Get Rich Education YouTube channel. Also, the link directly to that full video is in today's show notes. On the way out today, again, coming up on a future episode, retirement. We polled our GRE audience with the "Do you want to retire?" question, and we're also asking, what is retirement anyway? We're discussing both of those huge questions coming up here on the show. If you'd like to hear that episode and more, be sure to follow the show on your favorite podcast platform. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.